Right. Hello, everyone. Thank you very much for joining Miami Content Webinar Series. We are very happy and grateful that so many of you can join our webinars. I think it's really great that we can keep having these research forums during the pandemic times. So our speaker today is Jennifer Blouin, who will educate us on how corporate taxes affect risk-taking incentives. Before Jennifer presents, let me just quickly share with you the list of our upcoming webinar speakers. So next week we'll have Shumin Martin. Please mark your calendars. Also, let me quickly remind you the format of the webinars. So the speaker will present uninterrupted for about 20 to 25 minutes, and then we'll use the rest of the time for the Q&A session. If you have a question you would like to ask Jennifer, please post this question in the chat. And then basically I or Emmanuel will call you, to ask your question. Also, please have your microphones muted at all times unless you want to ask a question. Right, thank you. And with that being said, let me turn you over to Jennifer. Stop sharing my screen.
So let me share screen. Am I good? Perfect. All right, well, thank you very much. This is a fantastic opportunity, and I look forward to getting the feedback from a wide and varied audience, unlike I'd be able to just about any place else. So this is a co-authored work with Tom Kubik and John Robinson. John and I have known each other for a very, very long time, and John has worked very closely with Tom on this notion of taxes and risk-taking incentives over a period of years. And so this is a project that I'm not sure if they're listening, but that we've been working on and noodling on over a long, long time. And it's actually, oops, now I can't click through my slides. Oh, there we go. All right. And it comes back to some very, very old theory. Many of you are probably more familiar with this notion that tax rates dampen investment, right? That's why we just had the Tax Cuts and Jobs Act of 2017, where we brought the corporate rate down from 35% to 21%. And the notion is the higher the tax rates are, the less your payout to investment. And so therefore, the less willing you are to take that next project. But what we don't know as much about is the role that taxation plays specifically on the risk profile of investment or risky investment. And that's where we've started to see a series of papers revisiting kind of some classic economics literature over the past probably 4 or 5 years. So the theory that we're relying on actually comes from a 1944 QJE paper that was written about the notion of how we should spur investment after the war ends, right, back to World War II. And what they ultimately suggest is that the rules related to what we call net operating losses or loss offsets, right, can ultimately lead to this positive association between risky investment and taxes. And so what this leads to is that the higher your tax rates are, right, the US government is effectively shouldering a bigger chunk of the burden with regard to risk, and so therefore you're more willing to take on this risky investment. And so this is a simple, example kind of illustrating this point where, here we have 2 potential projects, the same project, but one with loss offset, where you get the benefit or the tax shield associated with losses, and the other one where you don't. So all I've done in these 2 panels is say initially we have a 40% tax rate, and next we have a 45% tax rate. And the basic story that Domar Musgrave says, like, listen, if you don't get a benefit for your losses, right? If essentially, when you have upside potential, you give a little bit to the government. But when you have downside risk, the government shares in that, right? You are unwilling, effectively, it becomes much more expensive to invest. So the relative payoff to investment declines. And so what's interesting to see here is, like, with this after-tax payoff, right, varies between 20 cents depending on whether or not you effectively get this shield associated with the loss. And so if tax rates go up, right, the spread, you know, with the loss offset, you're more willing to undertake that project because now you get this 23 cents. And so this is entirely what their story is that this sharing or this shouldering of the risk. But their paper was written, I mean, very influential. Obviously, we're still citing it today, but it was talking loosely about risk and investing in a financial asset. And so it's only at the very back of their paper where they start to recognize that this is actually a trickier question when you move to a situation where there's a real business decision or business assets that are being invested in. And that leads to Jack Mintz, then also has a very influential paper in the QJ from 1981 that suggests that this association is less unambiguous than what initially was suggested. And that's where we come to today, all right? So lots and lots of work on taxes and risky investment about what I call the entry of entrepreneurial capital into the economy, right? We want to subsidize, you know, activities like R&D, and we need to subsidize losses, or people won't go out and do really, really risky projects that we'd like them to do. But most of the work on this theory, on the link between taxes and risky investment has been theoretical, right? And so there's been little work that had taken on what happens within the firm after the firm has been in operation. So we either looked at entry, right, or we theorized what would happen, but empirically we hadn't done much with regard to the ongoing business until recently. And it seems like we've now had a paper a year that is looking at this association between risky investment and taxes. And so the argument that's listed chronologically, but I think all of these papers were in effect being worked on at the same time. And what I think is particularly interesting is all of these are by groups of authors in the accounting literature. And so Lundquist et al. Is a JAR paper that came out and made the argument that says there's a negative association between risky investment and higher corporate tax rates. So Langemeyer, Lester come back and say that there's actually a positive association between risky investment and higher corporate tax rates. Then Armstrong et al., my colleagues, come along and say, well, no, there's a positive association between risky investment and higher individual tax rates. And then, and I kid you not, right, we have Yost 2018 that actually documents that there's a negative association between risky investment and higher individual tax rates. And so pretty much you have every potential association predicted and documented in each of these four papers. Now I'm going to spend most of my talk in the discussion about the Langemeyer, the Armstrong, and the Lundquist et al. Papers, because Yost is a very interesting paper, but it's more about this notion of what I will call lock-in, which is a story about how an individual manager will behave given that he or she has enormous past accumulated capital gains in their equity portfolio. And so while that I agree influences their decision, and it's something that many of you may ask questions about and we can talk about a little bit later, it is less on point in terms of the other three, which are saying, listen, given a tax rate today and given compensation or incentives today, how does that affect what I do inside the firm? So the research questions that we approach is we actually come back and what we look at is we want to know what kind of risk is going on, what kind of risky projects are being pursued, what happens to the risk profile of the firm. Are we see changes in systematic or idiosyncratic risk, right? And if you have this change of, of risk profile of the firm, presumably because managers are changing their investment decisions, right? Does the compensation contract then get adjusted, right, to bring us back to equilibrium, assuming that we can measure that with any certainty? And so that's kind of what we focus on is there's this big controversy or variety of findings in the literature, but ultimately, how does compensation move? And does that give us some insight about what the likely link is between taxes and risky investment? why do I do this? Well, I mean, it seems, come on, I just showed you 4 papers that have every potential prediction that you can make. So to me, that seems like it's worthy of some thought to try and document, you know, a behavior that would help us tease out what story holds. So run the proverbial horse race. Now, on the other side, right, the real issue here that we're interested in and why all this work is heading down this path is, do higher taxes actually lead to an increase or decrease in investment, right? And in particular, risky investment. And then finally, is this really a story about corporate or individual taxes, right? Can we then help reconcile kind of what is going on in this work? And these back couple questions are really important because they have massive policy implications, right? So given that you invited a tax talk today, I thought it would be good to at least get back to our, you know, the roots of what we do in tax work, which is trying to make sense of policies that the US government puts in place. And in particular, the things that we're talking about today, these loss offsets and other types of targeted benefits, are specifically trying to incentivize risky investment. So if we have all these associations wrong, then, you know, then we need to step back and think a little bit more carefully about these policy, particularly the costly policy incentives that we put out there. And then finally, you know, this is, again, I come back to, I'll talk more about what this asymmetric treatment of losses. We just had a very, very significant piece of tax legislation that arguably increased this asymmetry, right? The rule is it used to be we were allowed to carry back losses for a couple of years, and then we're able to use those losses for 20 years in the future without limit. Well, what TCJA was actually took away the ability to carry back that loss and get an immediate refund, as well as it limited your ability to shield taxable income to 80%. So it has affected, right, you know, we could say the efficacy of this, of the role that, or the burden or the shouldering of the risk that the government would take through the sharing of the loss, the downside risk. All right. So all risk is not created equal. And that's really, in a nutshell, what we are trying to do in this work, by recognizing that managers are incentivized to pursue risky investment. But there's been this work that has come out, you know, Armstrong and Bashishta and Henderson, that are recognizing that, you know, even though Vega is intended to increase risk, the risk profile of the project, it's not clear the flavor of the risk they're going after is what we would want them to pursue as shareholders. And so this led to this, what we call risk-related principal agent problem, right? Because managers are so woefully under-diversified with regard to their employer's stock, right? They would rather pursue projects that add systematic risk, because they can essentially hold the hedge portfolio, as what compared to what we would want them to pursue as investors, which is projects with idiosyncratic risk, because we can diversify that risk away. All right, and so here what we've presumably identified maybe is a situation where we have a change in the risk profile or the investment project, the risk profile of the investment projects being pursued. So can we tease out, right, what type of risk, what rate is important, by looking at how compensation contracts move or adjust, all right? And that's what this notion of the incentive compensation contract that we look at, right? What we should step back and say, well, what do we know about tax rates and risk more generally, right? When corporate tax rates change, the presumption is, and what we've seen in the literature, is that this increases systematic risk in the economy, right? That affects risk systematically. And so because of that, we would know that if the relevant tax rate, or you know, in terms of thinking about what managers are responding to, if the relevant tax rate is the corporate rate, we should see changes in profile, you know, projects should change with regard to systematic risk. But the Armstrong et al. Paper suggests that personal tax rates actually affect idiosyncratic risk. And I'll come back to that, because I think that link or that association is a little bit muddier to me. And if anybody has any more insights on that, that would be helpful. But I think in general, when we see tax rate changes, it leads to changes in systematic risk, all right? And so if these changes are affecting risk, then presumably what we should see is a shift in the weight between equity and cash compensation. And so we can see these changes if we identify changes in tax rates, right? We can identify, then do we see changes in compensation? And from those links, then we can infer whether or not it's associated with corporate tax rates incentive, individual tax rates incentives, and then perhaps we can get back to looking at the underlying activity or investment activity that changes within the firm. All right. So how do we test our research question? This is why there hasn't been much empirical research on this for years, is because if tax rates change for everybody, all firms, then it's impossible to disentangle, find cross-sectional variation that we could exploit to find out or investigate whether or not tax rates and investments are linked. So we use, and I put it in quotes because many people will challenge us, is we use what we call the plausibly exogenous change in state level tax rates. All right. So we have 50 states and and DC. All of those have, well, not all, but many of them have corporate, many of them have personal income tax rates. And so we can look at those changes in rates, see what happens to investment, risk type, and compensation. So to illustrate what we do, of course, since I'm talking to a box, I like to put up as many pictures to illustrate what's going on. And so here's corporate income tax rates in 2015. So I'm just going to use 15 and 16, even though they are after our sample period, to show how both corporate and individual tax rates move over time. So in 15, here's where we stood, and you notice like the states of Washington, Nevada, Wyoming, South Dakota, Ohio, and Texas actually have no state corporate income tax rate. The rest of us do. And so in 2016, I can show you that these are the 6 states that had, in this case, in 15-16, we tend to be looking at state tax rate decreases. So these 6 states all decreased their corporate income tax rate between 15 and 16. So what does that mean? What about personal income tax rates? Well, same set of slides, right? Same set of years, but now I just flipped into personal income tax rates. And so between 15 and 16, what I wanted to point out is that there were 5 changes, but all of these, 6 changes, but 5 were decreases, right? There was 1, so the Connecticut, the red bar, is the only circle, that was the only example where we actually had a state income tax increase, whether it be individual or corporate tax rates in this period. But that the only state that did both, had both changes in its individual and its corporate income tax rate in this period is North Dakota. So what I wanted to illustrate with these graphs is that there's lots of changes over time because our sample period spans from, I think, 94 to 15. And so we have upwards of 40, increases in tax rates, I think something along 70 decreases in tax rates, but that the correlation between individual and corporate tax rate changes is not very high. It's about 25%. And so different states are moving personal and corporate tax rates in different periods, and some going up and some going down. So I do think, although these changes aren't huge, and I will say right out of the gate, I will fess up to that, right? The relative magnitude of some of these changes are fairly small. They do happen with regularity, and hopefully it's something that we can capitalize on in our empirical strategy. All right. So how do we test our research questions? Well, we use what we call the plausibly exogenous changes to figure out which tax rates are applicable as we look at the historical location of firms' headquarters. All right, but this is also a little bit loosey-goosey because we know particularly large companies operate all over the country. And so we have also procured what we call this NETS data, which is the National Establishment Time Series data, which allows us to come up with what simulates a nexus-weighted state tax rate change as well. And though that's something that we've just done, it's not currently in the paper, but I'll come back to the robustness of our results to that. All right. So then what we do is particularly address these Lundquist et al. Paper and also the Langenmeyer-Lester paper. So these are two papers that we said out of the gate are looking at behavior where they're studying changes or studying corporate tax rates and then seeking evidence of changes in investment. And it turns out that they find exactly opposite stories. All right, so this is just a summary of the two papers. Now they are using different settings. One is studying these US state tax rate changes, whereas Langenmeyer-Lester is looking at international settings. But so they're looking at country level and a cross-border situation. But the key insight here is that the Lundquist et al. Story is telling about a risk-neutral firm. And so their straightforward story is saying, look, Project C with losses is potentially riskier than Project B here. But the identical payoffs, right, that we see they're the same, right, even though the risk profile is different. And so all they point out is the fact that, well, because in the absence of loss offset, right, that is going to dampen your incentive to undertake risky investment. The key is they assume risk neutrality. Now, Langenmeyer-Lester come in and say, well, the important feature of this is considering the loss offset. What are the loss rules and how do you pay attention to that? You ought to. And so Armstrong et al. Steps in and says, well, we don't think decisions are made in the firm by a risk neutral manager, but rather, or by a risk neutral firm, but by a risk adverse manager. And so then their story comes in and compares not the loss offset rule, but just considers the relative risk of the two projects and shows that after you add taxes, what you can actually flip is your incentive to participate in the riskier project. Again, this is because the government is going to shoulder some of this risk. All right, so their story is once you have tax rates increases, right, that can ultimately, or higher tax rates can lead to situations where you increase or undertake more risky investment. And this is actually much more consistent with the Langenmeyer-Lester story, all right? And so these are the three papers that we speak to. In essence, because of time, what we can actually do is, compare the two stories. So rather than explain what's going on, we can just run effectively the horse race and say, do we see associations between corporate tax rates and individual tax rates? And which type of risk? Do we see systematic, idiosyncratic, and then can we see this effect in total risk? Right, all of these papers, it's in a figure, I believe in the paper where we sort of lay these all out, are all measuring different things in different periods and different manners. And so the only thing I want to say with regard to this work is I like changes, and so that's in a nutshell what our empirical strategy is. All right, so what we do is first we just look at risk and investment. All right. It could be ultimately that both personal and corporate tax rates are associated or influence managerial decisions. And so what we carefully do throughout our analysis is include both sets of tax rates. Now we use Armstrong and Vashishta's methodology for estimating total risk, systematic risk, and idiosyncratic risk. So first, and most importantly, what we find is when we put both types of tax rates in the model, it seems to be the corporate tax rate that is driving the change, or that is more associated with the risk profile of the firm. And this is just looking at the total level and seeing that this is consistent with what theory predicts. But what we want to see in kind of the punchline on our paper is, do incentives adjust, right? Is there movement in equity compensation? Because is the board aware of this risk-related agency problem, right? And if tax rates affect the risk profile of the firm, then there seems that there should be some adjustment to get back to equilibrium. And that's, kind of wrapping up where I'm going with this is, that's the meat of our paper, is looking at which tax rate are any tax rates associated with changes in incentives. And so this is just the increase in the corporate tax rates, state corporate tax rate changes. And here, as we see that as tax rates increase, incentive to undertake risky investment goes up. And so what the board does is dial back the incentive to pursue that incremental risk. And so that's where we see equity compensation or the incremental, exposure to, say, Vega, right? The next pot of compensation is pulling back on that, and cash intensity as a function of total compensation is increasing as well, all right? We find nothing similar to all the other work looking at decreases at this point. When we look at personal tax rates, we see some evidence when we just have increases in personal tax rates alone, but when we add the corporate tax rates along with the personal income tax increases, we don't find anything. And so then the last, I'll close here, is the relative performance evaluation. This is the niche feature, and this is kind of where we want to go. It's early work. We haven't exploited this as much as we'd like, and it's a little bit of working with this data is, not my forte at this point. But the RPE theory predicts that it solves this, risk-related principal agent problem by moving management's incentive to pursue systematic risk. It's trying to get them to focus more on the idiosyncratic component. And if that's the case, then those compensation contracts where we see this RPE feature, they should have less need to adapt or change. Just go to the compensation. The compensation contract once there's been a state tax change. And here is what we see is when we look at the sample, we just partition the sample based on whether there's an RPE feature. What you see is it's dominant, what we see is our association is dominated in the sample where that isn't part of the contract. Now, back up to the slide. There's only 660 observations where our RPE is 1, so we need to do further work on that. So this is just exploratory. And then for time, I will just say their next steps is continuing to look at this RPE feature. The lack of finding on tax creases needs exploration. We really need to think more about investment because it turns out that this past work has all sorts of association and measures of investment, which is very unsatisfying. And then finally, maybe we could capitalize on looking at the new tax rate changes, particularly the federal level change that we saw come through in 2017. So overall, we seem to find evidence, or we would make the argument that the Armstrong and Langemeyer stories are more consistent relative to the Lundquist et al. Paper, and that's namely that risk-averse managers make investment decisions that consider at least corporate income taxes rather than personal taxes. And that it seems like boards are at least somewhat aware, whether overtly or incidentally, sort of by accident, to this change in risk profile of the projects and therefore adapt compensation. So thank you.
Thank you very much, Jennifer. So let us turn over to the Q&A session. And the first question is from Miguel.
Hi, Jennifer. I like your paper quite a bit. And yesterday we had a discussion with our PhD students, and we'll forward you sort of the main points that came up in the discussion.
Awesome.
One that is sort of conceptual is, although the compensation results are very interesting, part of the paper is about reconciling prior evidence on risk-taking and taxes. However, it's not very clear what is sort of the primary objective versus where the primary contribution lies. I think the the part that is extending the literature is the compensation, and the other reconciliation sort of gets in the middle to get to that. So maybe, I don't know, you can tell us what do you see being the major contribution of the study and how everything links together.
Yeah. So this is a great question, and I'm sure Tom and John are probably listening to this, jumping up and down. I think you're right. It's the compensation that is the key part. That is the real contribution here. Now I should say that some of the other papers mention this, and it's almost like the other papers come, right, they find these associations and they recognize that compensation should adapt or should adjust. And so I think both the Armstrong paper as well as the Yost paper mention this, but say you never be able to tease this out and we can't look at it and sort of it's hard to think about. But I don't think it's very hard to think about. I think it's a very clear-cut prediction that comes out. Now, the horse race, and I agree that the rest gets in the way, but it's hard to not address the rest, particularly as one story is about individual taxes and the other work is about corporate taxes. So we can say, listen, we're just going to look at the corporate versus individual, and that's what I focused on in the talk. But it seems to me that the natural question is well, what do you find? Do you find the association predicted with risky investment from the theory? And so that's why I think we spend a lot of time, maybe too much time in the paper, talking about this link between tax rate changes and risky investment. And so I agree that the compensation is the right way to proceed, but I don't think we can ignore the link between, you know, taxes and risky investment. And I tried to be very forthcoming is that everybody uses different measures, levels, associations, and what's the right way to do this? I don't know.
Yeah, well, totally. It seems okay, but perhaps maybe presenting the results backwards, right? First, show your main result, and then the replication of what's a prior study in a different setting, right? Because your state level shocks replicate the prior studies with a different setting. That also links to compensation, but perhaps then it will help to say we study the effect of tax rate changes on compensation, which is one of the main drivers of the differences between state and individual taxes, corporate and individual taxes in prior stories. But I don't know, that's just sort of conceptually.
No, I agree wholeheartedly, and I will say my co-authors and I are, you know, at odds at this because they are. I mean, it's right. The compensation story, I think, is what's really novel. But unless I think we talk about this risky investment, I think we're going to have a heck of a time, you know, getting through the review process because it just is a natural question. What do you find?
Sure.
Thank you. So the next question is from Doug Hanna.
Hi, Doug.
Hi. Hello, Jennifer. I was wondering if you could talk for a few minutes about the power of the tests in your paper. Investment is determined by so many things, demand, technology, cost of capital, and you're looking at state tax rates, not even federal tax rates, and you've admitted that the changes are rather small. This seems like a really incremental effect to get considered both in compensation decisions and then an indirect relationship to the actual investment decision. Are you surprised that we've got variable results in this area? Are you surprised that you've got some, that you were able to find a result here? How does the power of the tests play a role in this field?
Yeah, I mean, and that's right. That is the kind of white elephant in the room is, oh my goodness, we're showing these really small percentages. And I think it's fair to be upfront about this. And I have to say, nobody was as surprised as I was. And, you know, back to if there's any tax folks who are sitting on the call, right, they always come back and say, gosh, what we're doing is back with these rates, right? First of all, you're using headquarter decisions, right? And that's loose. And we don't have factor apportionment exactly like what we'd want to identify exactly where these corporations are operating in. So that's loose. But yet, you know, all of this kind of noise in this measure, and we're not the first that consistently seem to find that firms move or adapt investment, capital structure decisions, right, for these state tax rate changes. And so if you are operating in the, you know, a federal level, and your footprint, though, is predominantly domestic, then the only variation you really have is at the state level. And so, yeah, I'm as big a skeptic, but I think that we would find nothing, right, if in fact this was just a noisy just pure noise. And the puzzling, and what I didn't hear in your comment, is the puzzling thing to me is why we only find this association in one direction, right? If the results are powerful enough to find the increases, but yet we don't have enough power to find decreases. So is that, make us doubt everything we've done? Or we look more into, say, state tax rate decreases, and there's a lot more decreases over time, but they tend to be smaller and they phase in over a number of years. And so that's where I think we struggle a little bit with power. But I think the issue is it's hard for me to tell a competing alternative story for our results. But I would agree that it's not clear that the board sits down and go, hey, California cut its tax rate by 1%. Let's worry about what's going on with compensation and adjust it. I just think maybe it's the profile of the firm, right? Or the profile of the projects just changes slightly. And this leads to, tweaks in compensation that aren't overtly related to the state tax rate, but come through incidentally in the risk profile changes.
Thank you. I think the stronger you can make the link between the state tax rate changes and your observed results, the less you'll have to worry about the endogeneity issue, which is always out there for everybody.
That's right.
Thanks.
Okay, so the next question is from Miguel.
One more thing regarding your paper makes a big several statements about how the exogeneity of the state level changes is what can give you identification. However, in your analysis, it seems that when you do the association between risk and investment, you really just have a panel regression on levels of tax rates and levels of risk. While in your second question, in the compensation, you have changes. And also, so that's the first question is, will the whole paper benefit from a more diff and diff kind of approach? Mm-hmm. And then the second question related to that is that this is a difficult diff and diff because you have different states that approve different level changes. Like it's not the same to have a 17% rate that goes to 19 versus 14 that goes to 15, right?
Right.
But maybe somehow the whole paper will benefit from a more diff and diff approach. I don't know what you think.
So I guess, so the levels regressions we run are looking at, right? So I think your critique is when we just have the plain risk regression, right? We have the corporate tax rate, the personal tax rate, and the risk of the firm. Because
that regression is really not the effect of an exogenous change in rates on risk. It's just the effect, the association between tax rates and risk taken, which is contaminated by a number of things, right? So for identification purposes, ideally, what would be nice is to make all of the paper a diff and diff, right? At least the changes. Now, the problem with the changes, I think, is that perhaps for your own consumption, I would look at the state-by-state changes, right? So run these as if you had 6 experiments and sort of see what happens, and maybe give some depth for example, the state that had the highest change was 6%, and this is what we observe in compensation, and the state that had the lowest level was 1%, and this is the change that we observe.
Right, and so that's I mean, there's not a footnote in the paper, but that's one thing that we have looked at is trying to get partitioned by what we call large changes and small changes. Well, and I should say that we spent a lot of time looking for where there's not small changes, decreases, right? Large increases and large decreases, trying to say, is this really where we see our effect? Because it should, our stories consistent.
And if you do that, then it's much easier to do like a typical staggered adoption design. Sure. Like this paper, I don't know if you remember, the one on distracting driving laws in JAR. Right. Yeah. All you need to do is an indicator post, perhaps another indicator high-low, and then state-level fixed effects.
Sure.
And really what you get is the average treatment effect of changing the tax laws by 1%.
Sure.
or from the low to the high in the high states,
Right.
right? Something like that.
No, I agree with that. And that's clearly and I think this comes back to Doug's point is, convincing everybody that the power in what we're capturing is coming through these changes, not some other endogenous issue.
Yep.
Sorry. Okay, thank you. So the next question is from Tyler.
Hi, Jennifer. I was just wondering, when you're doing the investment test, you find this result that the increase investment after tax rate increases. From my own experience in public accounting, right, there's a lot of planning, like these state tax changes you generally know ahead of time. And there's not always a huge difference between like an investment in December versus January. I'm wondering if you've looked at whether like that increase is really just firms shifting their investment to the higher tax year to get the immediate tax deductibility, rather than any, thought about kind of the riskiness of it.
So, okay, so great question. I think two things are baked in there. First of all is like, if you just look at, right, the notion of a tax rate change and investment, right, sort of suggests this negative association, right? Because that's why the higher your tax rates, the lower your investment should be. So that's one thing, is we're trying to get, this maybe intertemporal shift, but it's the notion of incremental or risky type activity. And I would agree, if we sort of had a really good way to measure, what's the aggregate amount of risky investment, and do they just push it off into the next term, right? Rather than create incremental, is what your suggestion is. It's just a blip into one period. We can certainly, I think this is back to the kind of the changes analysis, is we would expect to see a drop, right, in the pre-period of investment, and then a pop the next period. But I don't think we've run, that's a good point, because we run these leads and lags with regard to the changes in compensation, but I don't think we've done it with investment. And so that's certainly something that we could look at, rather than just look for the increase in risky investment. But I will say, right now, I think the investment story is all over the place. So first identifying the right measure of risky investment, step one, and then I agree that we could seek out the intertemporal shifting as well.
Sure. Yeah.
Good point.
All right. Thank you. So the next question is from Yini. Yini, are you here?
Hey,
yeah, hi. Yeah, I think my question is pretty much in line with Miguel's earlier suggestion regarding the difference in difference design. So I think you already gone into details on this one. So feel free to pass this question.
Yeah, sorry, Thomas, I accidentally skipped you in my chat. Yeah, so the next question is from Thomas now.
Be nice to Rome.
You want to finish Yini's, or?
I think her question was answered, right? So.
Okay. So my question, as I read the paper, I was really looking for everything I could find about when did the tax changes come, why did they come, how many were there, and I really didn't see it in there. Right? I was able to garner that less than 10% of the sample has a tax increase, and less than 10% has a decrease, just from the descriptives. But what you had in the maps, and I think you said there were about 40 increases and 70 decreases. Just more information about that, because I just worry that there's a reason why they changed the tax rate.
Oh.
And that reason is probably got something to do with economics, and it may cause firms to shift their risk preferences. So I was just trying to find out more about that. When they occurred, why they occurred. If you've got 110 tax changes in your sample, seems like you could get a little bit more detail as to what those were.
Right. So, and I will apologize is that this version doesn't, we kind of rely, we're a little lazy or sloppy on the Lundquist at all, right? Exactly the same data source. We just rolled ours out for a few more years. And so that's the story. Those are the, bulk of where those increases and decreases are. I mean, right, taxes don't change in a nutshell, right? Do we have situations when our big concern is that a lot of these changes were what we would call budget neutral, and that there was a corporate increase that was accompanied by a personal decrease. And that then what have we got going on? Has really anything changed in the state? But what we do is we don't know exactly why all of these changes came in, but we do try to control for a number of state-related issues in addition to incorporating, fixed effects, state level, or excuse me, year fixed effects, as we have the state level controls, I think, for whether, a Republican governor's in office, right? We look to R&D and changes in NOL rules and all those types of things that would affect this association. But in terms of why necessarily each of these rates comes down the pipeline, I'm not sure that we have that information. I mean, is there something specific that you're looking at or looking for?
I was looking just for kind of descriptive statistics. I mean, because until you said in the presentation that there were 40 up and 70 down, I don't recall seeing that in the paper. I could have missed it, but just more detail. Sure. About the frequency and the relative magnitude of how many of these were increases from 5.2 to 5.3% versus 5% to 7%.
Fair point. I agree.
Just more detail really would help with interpretation.
Perfect. I agree.
Thank you. So the next question is from Sundaresh.
Jennifer, it seems like the compensation mix is kind of a tricky thing to study, given, like the direct effects to the recipient and the firm, right? I mean, if state taxes go down, maybe I want to change the mix. I get more cash, less equity, because now it's, taxed at a lower rate, right? So, so the question is, how do you disentangle, kind of the direct effect from the incentive effect, to take on risky investment?
Right. And so I think there's two issues in there. One is there's the compensatory element, and this is where we struggle with the individual versus the corporate tax rate, right? We have a couple papers that are saying this is about corporate tax rate. We have a couple papers that say it's about the individual tax rate. And maybe it's all going on at the same time. And that's why I believe we're the first paper that's trying to consistently include state tax rate changes only for both corporate and individual rates to sort of see what's driving the corporate decision making. And so if I understood your comment correctly, is you're thinking about my personal wealth, right? How I as a manager is being compensated. But, for the group of firms in our sample, the biggest component of these folks' compensation is equity comp, right? So the decisions that they're making today might affect the amount of grant that they're getting, but the tax on that grant today is not out into the future. And so that's part of why I always struggled with the individual tax and corporate decision-making story on the here and now, is because I would think that corporate taxes are more salient in the decisions I'm going to make for purposes of investment inside my employer. And so that's why, we have, or at least I think the story is more about corporate taxes. But to your point, right, is if I'm in a state where, my personal compensation is changing, how does that then net against the corporate incentives? And that's why we include both in an effort to solve that problem. But I still think what's more salient today is, unless your cash comp is, how you make all decisions, right? Because that's the only thing that's going to be currently taxed. That would be the tax rate that should affect managers' decision today. The equity component, that's Yoast, and that's also why I step a little bit back, and I wholeheartedly agree. I need to think more about that lock-in story about your past appreciation. But I think that I find it more appealing to think of the story with regard to corporate taxes.
I'm thinking more about, it's not an investment story. I'm just talking about the direct effect of the company being able to deduct cash compensation now, not being able to deduct stock compensation, right? So, would the tax rate affect my decision on whether I want more deductibility now versus later?
So you're just saying that okay. Sorry, I completely misinterpreted.
It's not about.
I'm thinking one thing, yeah.
Yeah, I was trying to get at the fact that cash and stock compensation deductions happen at different times, and so that's what I meant by the direct effect.
So then, but then I'm trying to think what we would. So you're thinking that, but then cash compensation would just go up because in tax increase amounts because I get the immediate deduction. So that's the story that you're telling with regard to the cash, to the.
I'm just saying it's hard to disentangle, the investment related effect from, kind of the direct immediate effect.
Right. And we have percentage variables where I think the story you're suggesting is more about the level, right?
I think it applies to changes as well, right?
Well, but if we're saying if it's just the level story about, hey, I pay this guy $1 million and my state tax rate was 7%, right? If the state tax rate goes up to 8%, wouldn't you want to pay him? Wouldn't you shift more of the compensation? Wouldn't you want to have $1.1 million?
Yeah, and less equity, right? Because I get the deduction now; it's more valuable to me, the company.
Right, and that's what I'm saying. You should see a shift in the level of cash comp.
Right.
Right, yeah. I'm thinking of more of a level. That would be a way to tease that story out, is by looking at the level relative to the proportion.
Which I thought was what the mix is all about.
But this is the mix, is the percentage, right? Cash over total.
Yeah, so it's a substitution, right? Rather than give you equity, I get more deduction if I give you cash, right? So it's not that the total compensation is higher, it's just that the mix is changing.
Right, I was just, and I agree, but I would still think the story would also, at the margin, right, wouldn't I want to then pay, right, because essentially an incremental dollar of cash contribution, of cash compensation, because you can't reduce your cash comp, can you? I would think that it would be a level of, it would be a story about increasing the cash compensation.
Possibly.
Yeah, that's why I'm just trying to think of a way to tease those two stories out. That's a good point.
All right, so we have another question from Tyler.
Yeah, and this is a little bit more on kind of the theory, and I was looking at figure 2, and I know that, this isn't something that you prepared, because I think I've seen it in a couple other papers as well. But when kind of looking at, when the tax rate changes and the benefit that companies get from the loss carryback, the loss offset, I think in a long run sense, this figure 2 makes sense. But in the specific test that you're running, because it's always 1 year after, right, the immediate period after the tax rate increase, from a carryback perspective, we would think that the tax rate, the tax benefit that you get from the carryback would be the same as the prior tax rate before the change, just with how carrybacks generally work. And so I think that may change the utility, which you kind of mentioned in your paper, that the utility goes down when you have an increased tax rate. But I think it may end up going up if you assume that that offset is at the prior rate.
Right, and I will. It's a good point. I understand what you're thinking. But this would, suggest that it's one investment project that's going to throw this firm into a loss, and more or less, we think the story is not so much about the loss offset. The Langenmeyer-Lester does a nice job of sort of illustrating that this loss offset does affect risky investment. But you don't even need to have the loss offset story, right, to get this shift in what we would see as higher tax rates are going to incentivize riskier investment. Because I would make the argument, this is for illustrative purposes, but that on average, right, corporations aren't making investment projects in one state that are going to throw them into an average loss. And in fact, if you look at the sample that we're studying, right, these firms typically aren't running with aggregate NOLs. So this loss offset model is, I think, more of a story from a theoretical perspective, right? I don't think our sample is really incurring a lot of losses. But that,
I think that makes sense.
Right, we need to explain that because that's the Lundquist et al. Story, period, right? They don't take, they're essentially has a risk neutral firm, so they don't even get to this decision about utility.
Right, yep, that makes sense.
All right, so the next question is from Shane.
Hi, Jennifer. I really like how you've connected to the RPE literature. Can you talk a little bit more about how you measured RPE? Because it's very sensitive to how you define the peer groups, right?
Yes. And so this is the new, I am just very excited to embarrassingly have to admit, learn about RPE. And so this is my first foray into it. So my understanding is Incentive Lab, and I'm sure Tom is dying 1,000 deaths because I'm probably going to tell you wrong, codes these as a 1-0. And I know that's coarse and it's terrible. And I've started reading up about all this stuff from Park and Vredos, which, right, they just sort of said, listen, do you say peer? Because if you have peer, you must have RPE. But yeah, if there's this is where I want to go, because I think to Miguel's point, the RPE that's the cool feature, right? Yeah. That it's hard to tell a competing alternative story about why we see the effect, you know, and then not find it in the RPE sample. And so if you have suggestions or directions or places where we can do better, my biggest issue is we've got 660 observations right now. We must be doing something wrong when we link these data, because it seems like I've read more work that's finding several thousand observations. And so this could be a power issue at this point, but is there other ways to look at RPE?
So there's ways that you could measure it yourself rather than rely on Incentive Lab. So Anna Albuquerque's paper, I think, does a really nice job of demonstrating how to do that, measuring strong form RPE. But then you get into really nuances like, is it strong form? Is it weak form? What do you mean by a change in the RPE? Does it mean that you've got a stronger form of RPE, or so it becomes very nuanced then. But I really like how this is a great first cut at what you're trying to do. And I think a big challenge that you've got going ahead is, how do you decide what the firm does first? Do they change RPE first, or do they change compensation mix first?
Exactly.
And so that's a challenge going forward too.
So can I ask you a question, since I know you've worked and thought about this, I know RPE has been growing in use. But do you see I mean, and part of my concern are the compensation contracts like rewritten? Is there a precipitating event that causes RPE, or folks go, hey, look, our peers are doing it, so we too need to do it? Is there a driving?
So I don't know if that's been answered directly, actually, and I think we need some good field research to get at that. So ask people, you know, what do they do when they see changes in tax rates? And I think that this is a really ripe area to be doing research. So I thank you for doing the first cut at it, actually. It's inspired me to think about other things that we can do.
Thank you. It's fun to mix areas of research.
Definitely. Thanks.
Thank you.
All right, so our last question is from Vijay.
Hi, Jennifer.
Hi, how are you?
Good. So what's puzzling to me is you're looking at the mix as a ratio, but I'm trying to understand, is the mix changing because the awards are changing, or the value of the awards are changing because of changes in underlying fundamentals? So the story is, a state cuts tax rates, creates economic growth. Economic growth creates more investment opportunities for this firm. That means all the assumptions that go into Black-Scholes are going to increase the value of the options. but the number of options that are awarded are the same every year.
Right.
Like, I'm trying to see, is this a conscious decision by a board to create risk-taking incentives, or the option values are changing because the investment opportunity set changes because of state tax rates?
So, I mean, and that's a fair point. I mean, we do try to control for delta and vega, which is, these are the other, right? Shouldn't those in essence capture some of the other variation in, you know, the compensation that could be driven by these alternate activities? But you're right. I mean, disentangle which piece is moving. I mean, this is kind of, I think, a little bit to the question about cash compensation, and is the aggregate level moving up, or is it just kind of what's driving why the delta is dropping? Value, number,
Yeah,
right, et cetera.
because if you look at all the assumptions that go into option valuation, so dividends,
Mm-hmm.
so state tax rates may affect dividend policy, okay, may affect volatility, potentially affects growth.
Right.
And so if I have a pre-announced same number of options awarded every year, the value of those options are affected by state tax rates, independent of a conscious decision to change the mix.
Right. And I agree. I mean, we are well aware of this issue, and that's why we try to control for so many elements. But I think just looking at the number might be a way to sort of say, look, this is partially what's moving. I mean, otherwise it's a catch-22, right? This is why compensation literature is so difficult. Now, what I will say though is, like dividend policy, if this is a large firm that's operating across multiple jurisdictions, then it's only the top tier, right? That why would the dividend policy across why would all the different state tax rates affect the dividend policy for the top tier entity in the top state, right? I mean, and that's kind of what we're trying to get enough variation, is it's not just everything at the headquarter level, right? All of that's completely endogenous. We don't know. We know that delta and vega incentives change because tax rates change. So are the components, are they actively messing with the components within these three pieces? We haven't done that. But I think just looking at number would be a useful starting place.
All right. So I guess we'll end here. Thank you, Jennifer, very much for your presenting your work and also answering the questions. Also, thank you all for joining the webinar. If you have any questions or comments left, please email them to Jennifer and her co-authors. And have a nice weekend. Thank you.
Thank you. Thanks for having me, guys.
Thank you.
Bye-bye.